Good afternoon to everybody joining today. Thank you very much for making the time. I know everyone's lunch is valuable. We are going to give everyone a few more minutes to join. We are quite heavily subscribed today, actually. There are over 250 people have registered. We have just over 75 people that have logged in so far. So we'll give it a couple of minutes and then we'll get going. Just give me 2 more minutes. Thanks. Right, okay, it's 12:35. I think we'll make a start now, and hopefully you can see the slide deck on your side. It looks like it's okay on our side. So again, thank you very much for everybody that's made the time to join. This is another webinar in a long, well, it's not long running. We've only been doing it for a year or two. Typically, our presentations are in person, and they are on invitation by groups, normally some of the accountancy groups around London and in the southeast. But these webinars are becoming really regular. We aim to do them every sort of once a quarter, but sometimes it's a little bit sooner, sometimes a little bit later for various reasons. And we do like to tailor the content as people do write in and ask us to cover various things. So we'll see that today. Today's webinar is titled HMRC Tax Investigations Practical Know-How. It's a shorter name this time round, but I think the gist of it is as you understand our background, you'll know what we're going to cover. It's not too different from the focus on HMRC's frontline, the focus on HMRC's drive to increase WDF disclosures. But there are some new bits and pieces here around tax avoidance today and the temporary repatriation facility as requested by people. So we're going to get going. I'm Amit Puri. If you don't already know me, perhaps you've seen emails that come from us. Hopefully you do. Many of you are in contact with us anyway about some of the issues your clients have from time to time. So okay, we'll get going. We'll start with looking at what we're going to cover today. So I'll tell you a little bit about myself, but I'll keep it quite brief because I suspect a lot of people have been on these webinars before. We'll talk about the team here and what we do. The first part of today's session is going to be focusing on HMRC. Where do they get the information from? You know, what's automatic, what's maybe a bit ad hoc. Then I'll set out what the customer compliance group looks like at HMRC now. So, you know, those that are old enough will remember enforcement and compliance, but it's changed its name a while ago. It's where HMRC's entire front line sits. And I've got a pictorial of this as well, which should help you understand where you might see letters coming from more often than not. And then I'll cover a little bit about how they approach their inquiries, pre-registration and during the inquiry, just to give you a hint. But again, I suspect some people know this already if their clients have been subject to inquiries. We're going to move on to the WDF, and specifically HMRC's nudge letter campaigns, which I'm sure agents are seeing a lot of. We certainly still get phone calls from clients about this quite regularly. There are going to be a number of slides I'm going to skip today, but I've kept them in deliberately, so I'm hoping that when I send them out, they're of use to people. Some of them, for example, will give real life examples like case studies about failure to correct penalties working in practice. And there are a few others that we've been covering in other webinars recently, but we'll run out of time if I do them today. So they'll be in the pack when they come out, but they won't be covered today. We have been fielding calls and having meetings around property portfolio, buy-to-let portfolio problems caused by planning over the last few years. It's been coming up a lot because HMRC have finally been doing a lot in this space. So if I said to you property 118, less tax for landlords, and B2B trading, maybe these names ring a bell, but we'll cover that towards the end. And on demand, the temporary repatriation facility. But again, some of the slides will be a little bit more helpful, which you can look at when you get them. So just on me, for those that don't know, I'm an ex-tax inspector from HMRC. Started off life in inland revenue as it was then in 2004, before the merger with Customs and Excise. I spent a few years in what used to be called local compliance, large and complex. It's now been sucked into what is wealthy and mid-sized business compliance. I'm sure people get letters from that part of HMRC. But I spent most of my time in what's now called Fraud Investigation Service, probably about 8-9 years. That's where Code of Practice 9 tax fraud investigations are carried out, and also Code of Practice 8 investigations, which are normally short of a allegation of tax fraud, but nonetheless they cover evasion and deliberate behaviours, looking at a number of tax years and a number of companies and their accounting periods. So quite heavy duty stuff rather than a routine compliance check. That's also where I became the team leader for offshore disclosures, and I was so for about 2-3 years before moving into a policy role at HMRC. So we've seen a lot of disclosures. I manage them on HMRC side, hundreds and hundreds of them. Today you see them known as the WDF, but you'll see a slide later on. Things have moved on in terms that there's no longer really a carrot when it comes to disclosures, only really a stick if you don't volunteer these things to HMRC. When I left HMRC, I went to Grant Thornton. I was head of tax investigations there in London and Birmingham for 3 years, and then I moved off somewhere, a smaller boutique in London, and today you see it as Pure Tax, which I manage and run with a small team. All we do is tax investigations, business inquiries, and disclosure work, because we stick to what we know. We don't do any tax compliance work. But the team does comprise accounting qualified members, whether that's AAT, ATT, CTA, for example, but we only really do tax investigations and disclosures, as I've just explained. But we do bring together the necessary expertise within the team to do what we do, which is looking at tax issues, penalty issues, and even anti-money laundering checks that HMRC carries out as a supervisor. But it's not always about money. It's also sometimes about naming and shaming. Manage that from HMRC's perspective or the client's perspective, making sure that reputational risk is reduced, and obviously large-scale business inquiries. It's an important point that I make here, but I won't dwell on it. The work for us, this type of work, is all non-recurring because the clients remain yours. As trusted advisors working with your clients for a long time, they come to you for help, and we hope that some of this work, if it's not manageable, and if it's more complex than normal, you understand and accept that we have the resources to manage those and our expertise, but the clients never really become ours because we don't do compliance work. The work will end. It's finite for us. I'm not going to cover this slide today because I think most people understand the point of it anyway. The reason why I hate tax is so complicated is because of the countermeasures. Every time there's a new relief or a new giving mechanism, shall we say, and HMRC constantly clamping down on tax avoidance. Again, today is not the day we go through DOTAS or POTAS. It's entirely different world and it's very, very complicated. But we are going to cover international information exchange and WDF. So let's move on to where do HMRC get their information from? As you might expect, of course, HMRC get information ad hoc all the time. This intelligence comes from your staff in your businesses, whether they still work there or they've left. It might be your neighbour. It might be somebody else that's got an axe to grind and sends information to HMRC. But importantly, this is intelligence in HMRC's hands. They should really check it, verify it, and look at other sources of information before they do something about it, because there's an awful lot. They also buy information bulk, and sometimes they get bulk information for free. It depends where people manage to get their hands on these things from. And other information comes from live inquiries, live investigations, so spin-offs, if you will. And of course, regular intelligence streams. This is information that comes in every year automatically to HMRC and has been doing for a very long time. This is not Schedule 36 information that HMRC have called for in an inquiry. This is banking data. This is data from other government departments. This is crypto-related platforms that will be sharing automatically, but some have been compelled already, so that information is there. I'll give you an example of that shortly. All of this information goes into Connect. There's a lot to be said about Connect. Most tax disputes experts will write about Connect at some point or talk about it, but some of them maybe have not been around in HMRC to know what it actually looks like. In my time there, it was called something slightly different, but it was building. It was growing at that time. A lot of money has been spent on HMRC. And on these figures, you'll see HMRC claim that they've made over £3 billion in their inquiries through the use of Connect. I mean, that's debatable. We don't know how they come up with these figures, but we know they use them, right? When I was there, they used them before inquiries were opened to provide a bit of an intelligence pack to investigators. But we also know that Connect feeds into projects from which then cases are selected to run from. So it's been around for a long time, and I don't think it's going to go away, especially with the way digital information is going. There'll be more and more of it. Famously heralded as being bigger than the British Library, so more information here than the British Library itself, which I can believe. My figures here show, the last time I checked it, there's over 55 billion lines of data here. So it's an enormous amount, and I suspect it's growing all the time, especially when social media and other online sources have been profiled and added all the time. But in terms of fixed databases, that's been over 30 databases going into this annually for a number of years. I'll give you some examples next. You won't be surprised to see that UK bank account data goes to HMRC, but it's quite basic. In terms of TESAs, ISAs, PEPs, for example, the old tax efficient accounts, HMRC gets to see what the interest was on those accounts, as well as how much has been contributed annually. But for every other account, basic ones, your high street banks, they'll only really be reporting the interest income earned annually. Overseas information, though, from banks is much, much more different, and I'll cover that on a later slide, but it's much, much richer, which is why they're able to do WDF style nudge letters to people. Mortgage fraud information from banks has been coming in for years. Work and pensions and DVLA send in information all the time, which HMRC have at their fingertips. DVLA interestingly tells HMRC about number plates as well as the ownership of cars. Not how much they've been bought and sold for, but certainly who owns them at any time. Land registry is one of the important ones for HMRC, certainly used in lots of inquiries where properties have been bought and sold. So that information is quite important. HMRC get to see who the lenders are, as well as the conveyancers and the lawyers that are involved in transactions as well. Council tax information on private rents to landlords has been there as well for a while. I won't go through all of these, but online marketplaces have been sending information to HMRC regularly now because they've been compelled a few years to do so. Social media is a bit different. When I was at HMRC, social media was trawled, but only from a policy perspective, to see whether new things that were announced at budget and autumn statement, see what the sentiment was around those, as in how easy it was going to be for the Treasury and HMRC to bring about new legislation. But now HMRC are trawling public profiles to use in their risking function. This was actually in the papers 2 weeks ago, so if anyone missed it, if you Google it again, you'll see HMRC have admitted for the first time that they are all over social media sites to carry out the regular risking function as part of their compliance efforts. But there are other databases, like I said, crypto-based spaces like Coinbase and a few others have been forced to share information. So that's there. Your Booking.com, Zoopla, Rightmove, Gumtree are on there. Property registers from UAE have been coming in almost annually for a number of years now as well. And there are lots of other information, but I won't go into that. I don't want to bore you today, but you get the point. Yeah, this is 30 to 40 databases coming in all the time, but data is bought or shared with HMRC ad hoc, which it makes its way here as well. What I didn't do though is explain when I mentioned a spider diagram, that if I put someone's name in there, for example, Ishan on my team, if I wanted to pull up a package about him, I'd put his name in, his date of birth, and or his address to make sure I got the right Ishan Patel. But within seconds, the screen will be full of all this information which is coming from these databases. And actually it's unwieldy because it will connect to Ishan's partner. And I'm talking about business partner, maybe spouse, properties that he's been linked to, and all the other accounts. So actually, you actually have to sift through this information, so you're left with less. So you actually do something with it because the results are quite rich. So moving on to HMRC, these are the parts of HMRC, or directorates as they were called, that we still see a lot of activity from. That doesn't mean they're the only ones. There's two more. I'll show you on the next slide. But interestingly, most people that receive an investigation from the heavyweight side of HMRC is going to see on the top right hand side, it will say Fraud Investigation Service, right? Said many names. This is where I was at HMRC. It was specialist, civil investigations, special investigations, and it has names like Inquiry Branch from before my time. FIS is now about 5,000 people, last time I checked, for the year ending March 25. However, that does include the old criminal investigations as well as the civil part. So, take note, it's a heavyweight part of HMRC where the most serious investigations are done. So it follows that these investigators will have less investigations on at any time. Where you're likely to see the most inquiries are letters that come from ISVC and WMBC. And as I said, I started off life in local compliance, which is what it originally was, and it's been split into two now. These two directorates make up the vast majority of HMRC's frontline resource, hence why you'll see letters from them here, whether it's an individual, small businesses, what was the old high net worth individuals unit, which is now wealthy. Even campaigns were likely to be run from here. It's swallowed up and other directorates that used to exist, like Specialist Personal Tax International. Most of that's gone into WMBC, but it had the IHT teams, trust teams, anti-avoidance specialists, people that are looking at non-domicile rules, remittance basis, transfer of assets overseas, at the settlements legislation, for example. Huge parts of HMRC, but they have been absorbed largely into WMBC now. People will see letters from RIS. Once upon a time, the Risk Intelligence Service was more about preparing cases for frontline resource, but also going out and managing the buying of and the receipt of data, and as well as they have a network of HMRC people around the world sitting in the embassies and working. But over the years, RIS have been responsible for spearheading task forces, running campaigns. So don't be surprised when you see a letter from RIS. On last check, when I looked at it, there are about 28,000 staff working in the customer compliance group, and I'll show you a picture of it in a minute. But it's important to note, HMRC is only now 67,000 people. So that number represents nearly half of everybody at HMRC. Some will be surprised, thinking that actually 67,000 people, why isn't everybody frontline? But you'll be surprised. There is a lot of strategy resource at HMRC. There are lawyers, there are analysts, there is the education part. It's much bigger than anyone thinks. It's probably too big, to be honest with you, quite bloated, but that's a different conversation. But if we focus on the frontline resource, that's what it looks like, customer compliance group. And like I said, there are two additional ones. LB is large business, and the counter avoidance directorate is there as well. Counter avoidance actually used to be made up of some of these other teams, and then it's split up. And like I said, this comprises about 28,000 people at HMRC, and almost certainly where you're likely to see a letter come from in relation to a compliance check or an inquiry or investigation or a disclosure. So how do they operate? What makes them different? As you'd expect, large business is very, very different. They have customer compliance managers, as they call them now, that they used to be customer relationship managers earlier. This is where your Coca-Colas, your Amazon, your Googles, your Yahoos will be. The largest multinational businesses will be looked after by the customer coordinators. That's because they're talking to the finance teams and the CFOs and the FDs all the time. There are formal inquiries, but it's one way to look at it is that they are always under inquiry, and their strategy is constantly under review, and their management information is often shared by HMRC in real time. So it's a very, very different environment. You have a named customer coordinator at HMRC who you talk to. That coordinator will use a team of specialists at HMRC, so it'd be employment specialists, national insurance specialists, VAT specialists, customs, or even a specific type of excise specialty. That's how it works there. A lot of resource goes into it, but you need to do that because otherwise, the average person on the street thinks that these large businesses get away with murder, which is again a separate question. I'm happy to take that offline on another day to explain what happens there and why it happens like that. But it is a very, very different world. There's a lot of money. There's a lot of money to be made for HMRC when they find an adjustment and secure it, but the approach is very, very different. That doesn't mean that large businesses are not looked at by WMBC, because they certainly are. So the businesses that are not large enough to be an LB customer, so that's, I can't remember the numbers here. If they're not large enough to be in LB, they will be picked up as an inquiry. So this is not these very, very large, but not in LB. They will be picked up for an inquiry based on the risks that HMRC find, just like in smaller cases, just like in cases focusing on individuals, right? They don't have a chummy relationship with a customer coordinator that is live all the time, right? So they are specifically, for want of a better word, picked on by HMRC when the need arises. So that looks quite different. HMRC often in the largest cases will come and download all the data from a business spanning a number of years, because they tend to look at VAT, corporate tax and employment issues at the same time. And in doing so, they will produce an action plan, and they will bring, again, a team with them that focus on VAT, for example, or employment issues as required, and work with the business. So the business does need to put up a lot more resource as well. It's unfortunate sometimes because some of those businesses will be large, but they're not as lean perhaps as the LB type businesses. But that's something that has to be managed. ISBC takes a similar approach. All these compliance checks typically arise from risk assessed projects. So these projects are typically created by RIS, like I explained earlier on. There's not much scope in these teams to self-generate cases. So an inspector is not going to do that. They're pre-risk cases that they sift through. And the point here is because HMRC will have to be seen as following clear blue water rules. So when I say Chinese restaurants, Indian restaurants and cabbies, for example, it's because that was outlawed effectively a long time ago. When I started in 2004, I was told how they used to run cases and find them in the local areas, used to be called district offices. They're not allowed to do that anymore, right? So the idea of RIS was that the part of HMRC that selects cases from a risk base are not the people that then run them. So moving to fraud investigation services, like I said, it brings the old civil part of SI in there, and there's the criminal part as well. They are different. Where WMBC and ISBC inspectors might be running 30, 40 inquiries, expecting for most of them to close after a few rounds of correspondence, because they do normally ask for something that their advisors normally have. It's just not made its way onto a tax return, so they don't have it. FIS is different. They can be preparing for a case for 3 months, 6 months, and even longer. Right? I suspect that some of the criminal units are taking even longer to prepare, because they have to be ready to arrest someone, have to be ready to do the interview at the police station. Civil, they don't have those issues, but still far fewer cases. I would hazard a guess between 5 and 10 investigations. I certainly didn't have more than 8 or 10 on the go at any time. COP 9 and COP 8 investigations are quite heavy duty, because you're looking at the individual, all of their businesses, as well as partnerships and trusts, for example. So all of that together is normally one investigation. There's a fair bit to do. and we'll move on. Like I said, this is one of the slides that I'm not going to cover today. But Indian interest, certainly interest income that's exempt in India, causes a lot of people issues, certainly when they've got to deal with these in a WDF disclosure. That's not for today, as are mutual funds, because the market is very buoyant around the world, not just India, for example. But people need to understand that a lot of funds that people invest into will be subject to income tax and not capital gains when they sell their units. But again, I'm not covering that today. But moving on to the CRS, and I've alluded to it already a number of times. Why do HMRC do so many nudge letters? Why do they send out 10,000, 20,000 letters every month, every other month? Because that's what they do, right? It's because they've got a lot of information, right? Automatic exchange of information internationally has changed drastically over the last 10 years. I'm not going to talk about FATCA today, the US protocol that started the CRS off, but what I will focus on is CRS, because that's something that the UK was part of in terms of leading. It gets information from over 126 countries every year, and it's quite detailed. It's more detailed than UK information. It's not just restricted to interest income. It will explain dividend income that are in portfolios. It will look at other interest that is not falling into regular categories like interest and dividends. If it's a portfolio account and stocks and shares have been bought and sold, normally the gross proceeds from those are reported to HMRC. Again, if there are investments in these accounts, you don't need to. Previously, only cash balances were reported to HMRC, but here even the uncrystallized values on these investment accounts are shared with HMRC. So very, very rich. And there are other quirks here, which mean even companies, for example, that people use to hold investments in, they can be identified as well because there's a reportable person. Those reports come to HMRC. But for our purposes, the CRS went live in 2017 with 2016 data being shared for the first time. The whole of Europe, for example, India and many other countries, there are about 40, 50. They started sharing information with HMRC UK automatically every year, and vice versa. HMRC sends information there as well. It's very, very important, but not to forget, India were early adopter. They started in 2017. Your likes of Switzerland, Monaco, Pakistan, UAE, Singapore, the other sort of finance houses, or where the types of people that we deal with a lot, they started to share information since 2018. So it's not something new. It's not a surprise. This rich information has been coming to HMRC for a long time. And this is what HMRC use to send out when they flood the market with their letters that say, we think you've got a bank account overseas. Do you want to do something about it? I'm not going to go through this slide, but it's useful for people that have been in practice for a long time to remember why we are where we are. The WDF disclosure regime has been running for some time now, since 2018, since before 2018. There's no end date. It is the preferred method to do a disclosure where offshore accounts and offshore investments are involved. But look where it came from. There were Crown dependency disclosures facilities before. Liechtenstein disclosure facility was a big one because despite its name, it allowed people with assets and investments from around the world to make declarations to HMRC, avoid criminal action completely from day one. So there was immunity there, and there was a fixed penalty of 10%, no matter what you did and why you did it. And obviously they're the forerunners, ODF and LDF, ODF and NDO, sorry. But again, it's, HMRC have come a long way in terms of getting information from overseas and running campaigns to collect information using a one-to-many is what they call it. They did call it nudge letters originally, but that name seems to have changed. We on this side of the fence call it nudge letters still. HMRC call it one-to-many, basically where they don't do one-to-one inquiries or investigations because that's resource intensive. I'm not going to talk about requirement to correct window anymore because it's not important, but what people should remember is as soon as that window closed and people hadn't made disclosures by the 30th of September 2018, that's when the new penalties, which do apply now, called failure to correct, started. Right? What HMRC essentially is saying is, well, we've been talking about offshore issues for years and we've had many disclosure facilities because people haven't made disclosures, but you're telling us about it now in 17, in 21, in 24, 25. I'm sorry, we're going to use the failure to correct penalties. These are heavy duty penalties. So up to the 15-16 tax year, anyone that's got tax to pay will you be immediately susceptible to the FTC penalty? It starts at 200% of the tax. And actually, if you do disclosures and the FTC penalties apply, the absolute minimum it can be is 100% of the tax. That's irrespective of the behavior. It's got nothing to do with being careless or demonstrating someone wasn't being deliberate. You know, the penalties apply as soon as that tax is payable in the years up to 15, 16. So if someone waits for a letter to come from HMRC, a nudge letter, a little brown envelope, and you decide, okay, now I'm going to do a disclosure, the minimum penalty in those scenarios is 150% because you've been prompted, right? So it's quite high. And at the same time as FTC penalties came about, a whole host of other measures were introduced as well to really hammer people with assets and accounts overseas because they want people to voluntarily do disclosures. So people would have heard about the naming and shaming tool that HMRC have. And most people probably know that you have to be found to have done something deliberate. So there has to be a deliberate penalty in those scenarios for your information to be published. But remember, where offshore penalties are concerned, you don't have to have done something deliberate. If the FTC penalty applies, even though someone thinks, oh no, I didn't mean to do it, I could have done things better, but I haven't been dishonest. As soon as the FTC penalty has been charged, that's a trigger for naming and shaming. It makes it much, much easier. And there are a host of other penalties here based on asset values, for example. We've never seen this being charged in practice, so I'm not going to cover it now, but I will leave you with some other things to note. For example, where people do tax returns, but they find themselves in an inquiry where offshore issues are being dealt with, or they're in a disclosure, a WDF scenario, and they're working out how far back they need to go, right? So this gives you an indication. In cases of carelessness, HMRC can't go beyond 13, 14, for example, but they will have at least 12 years always to collect 13, 14 onwards taxes. I might be losing people here a little bit because I'm trying to race through, but the point to take here is that the usual 4 and 6 year rules don't apply where offshore matters are concerned. HMRC have up to 12 years to collect those taxes, and these are the backstops for the moment. So HMRC can't go further back than these periods. But where people don't do tax returns but need to do a WDF disclosure and deal with offshore issues, HMRC can go further than these periods. On paper, they can go back up to 20 years, but there are ways of stopping it around 9, 10, which is what we do in disclosures. Again, the rules have changed significantly over the years. Offshore penalties don't only apply to income tax and CGT, they also apply to inheritance tax. Offshore matter is not restricted to interest income arising overseas or gains that arise overseas. It's also now applies to monies that are maybe being diverted from the UK. So the UK business, but someone's received that money overseas, that now constitutes a transfer, or if it's landed in the UK and someone's then systematically moved it overseas, and that's found out in an inquiry, again, that will trigger the offshore penalties because it's an offshore transfer. Don't forget there is a custodial sentence that HMRC can use in relation to offshore taxes. Again, I've never seen it in practice, so I'm not going to cover it now, but certainly the stick is quite strong. So people really are encouraged to do voluntary disclosures as soon as they can and not wait for HMRC to write to them, nudging them. So here's 3 slides that give case studies where FTC penalties can be seen in practice and how that works out for people. I'm going to leave them in the slides deck, but I'm not covering them today. I'm going to move on to the tax avoidance slides that I was talking about earlier. So I suspect lots of advisors are seeing these letters and people that we know are receiving them, such as people's interest in bricks and mortar and property investment. But it's important to highlight this because sometimes we see HMRC by way of a news article online because they say they're not happy with something, but that doesn't necessarily mean that you see action from them. You know, you won't see a barrage of inquiries. They don't automatically run a disclosure facility per se either. But recently, in the last year, 2 years, certainly there's been a lot more action in this market, and I'm going to cover some of that now briefly. I'll be very surprised if people haven't read what Dan Needle's been talking about, which is the sort of hybrid partnerships. I think it was very much Dan that exposed hybrid partnerships, which led to HMRC issuing Spotlight 63. When I say hybrid partnerships, I'm talking about the types of planning that less tax for landlords were promoting and pushing in the market. It's where an individual or a handful of people together were encouraged to set up a limited liability partnership. There was always a corporate that was inserted there as well. The idea being that income was diverted largely to the corporate so that the tax rate was lower. Finance costs could be claimed by the corporate because the restrictions on mortgage interest and finance costs only apply to individuals. There were promises of IHT applying to this business now as well. There were lots of promises, but actually, when we used to look at some of this stuff, we weren't comfortable with this because there are old anti-avoidance rules that stopped corporates being introduced into an LLP anyway. We didn't think that worked because HMRC always had the ability to reallocate that excess profit to the corporate back to the individuals. And now HMRC have made that clear in Spotlight 63, but they've gone a step further. They're looking at CGT on the transfer of properties into the LLP. They're looking at CGT when capital sharing changes in these LLPs. They're even talking about ATED now because of the corporate that's been introduced into the LLP, which is a new blow for landlords. And of course, stamp duty. It's been largely glossed over previously, but now it's dawning on people that they could have triggered stamp duty issues as well as part of this planning. So it's a very, very messy area here because whilst we have done some disclosures in that space, and from time to time, bespoke settlements are reached in inquiries that are running, for example, anyone that is picked up from lists that HMRC have about less tax for landlord users, and even Property 118 users, for example, or copies of these planning, they get a very different treatment now because HMRC are writing to them en masse, and these letters are coming from counter avoidance. So the approach has to be quite different. What I will say, in the summer, there's been a lot of action because HMRC gave users of a lot of schemes, especially less tax for landlords, 90 days to make disclosures to them. And that was in May. And the reason why they did it is because they've got enough information from the promoters already to raise assessments. But obviously, HMRC being HMRC, they want people to do disclosures rather than them having to pursue people by way of inquiry afterwards. And we are seeing that now. We are seeing threats of assessments, and the assessments no doubt will be made before Christmas, I think. So it's a very heated market where hybrid partnerships are concerned. And the other big one, obviously, was the regular incorporations. Property 118 were behind these by a long mile, but so were less tax for landlords, as well as lots of I say, bastardized versions of this planning. We see a lot of agents or smaller outfits copying this type of planning. But the problems here were different, right? So there isn't a LLP here, but the focus was on incorporation relief for CGT purposes, right? Satisfying the qualifying criteria for Section 162 and basically saying no stamp duty applied either. The problem we're finding here in practice is that there was a one-size-fits-all product that was pushed out into the market. So people had, let's say, 2 properties. They were given this solution, should we say, and some people might have had 10 or 15 and thought they were running qualifying businesses. But quite frankly, if they weren't actively involved in the businesses because they had letting agents and they were professionals, there might be there might be bankers, there might be dentists, whatever. They had other things they're doing full time. They weren't going to satisfy the qualifying criteria for CGT relief. I'm just giving examples here, but what I'm saying is that the market swept so many people in, but there was very little by way of bespoke advice, really checking to see whether people qualified for the CGT relief and qualified for stamp duty relief, for example. So this sector is still on heat as well. A lot of people find themselves stuck here. We're having much more luck in terms of disclosures and settlements with HMRC here because a lot of people we're speaking to do meet the criteria for the CGT relief and other reliefs, for example, because on a case-by-case basis, their circumstances were different. There might be, a lot of the people we're speaking to are full-time landlords. They don't do anything else. They do run active businesses. They did tell the lenders once they entered into this planning that the companies now need to have the debt. So they did that in different ways. They might have used bridging, for example. Some were encouraged to notify land registry of change of ownership, for example. Some went on to do it, some didn't, but certainly the ones that have gotten much further in terms of securing this relief. Interestingly, the ones that find themselves in trouble have done nothing more than sign a document that says, well, yes, Gov, I own these properties legally, but not beneficially anymore, right? But my name's still going to be everywhere. I'm not going to tell land registry. I'm not going to tell the lenders. I'm not going to tell the tenants, and even our paperwork will just continue the way it was, for example. So you can see how aggressive it looks to HMRC to pick up something like that. So, be aware in the property market. It's not just the big promoters that have caused problems for people. There are lots of copycat planning out there. A lot of people need help in this space. And I'm not convinced they are finding the right people to help them along their way. This is the other avoidance scheme that I wanted to tell people about. And this has come on request because we've seen a lot of this over the last 4 to 5 months, I would say. I do remember reading about this. This is really, well, it's not that old actually. HMRC only started talking about it at the beginning of this year in 2025. They said they'd found advertising scheme which encouraged businesses to spend with them, and by doing so they got a corporate tax deduction, and obviously it could recover the VAT as well. That's what they were told. But lo and behold, about 70 or 80% of what they spent was going to be put back on a prepaid card for them to be used. So that's often the business owners or their staff. Slightly different version of this as well. There were loyalty points that were awarded as well, but those each point equated £1. So it still brought people back to the 70-80% came back to people to use. So HMRC had become aware of this quite quickly, actually, unlike other schemes, which led them to issue Spotlight 68. And we know they are actually pursuing the promoters and people that sold the schemes for the promoters or introduced their clients, as well as the users, in a very, very aggressive way. I say this because it's quite different. It's quite different to what's happening on the property side. It's quite different to what's happening in a lot of the old disguised remuneration and EBT style avoidance schemes. It's very innovative, if I have to be honest with you. As a firm here, we are working with only a handful of users of the scheme, which have got letters from HMRC. So we're trying to work out how much of the expenditure is going to be allowed on a wholly owned, exclusively incurred basis, and how we deal with the clawback. HMRC are saying that we want PAYE, we want mix, but that's not always the only answer. We're dealing with obviously small, close companies. A lot of these people aren't taking salaries anyway, and are into dividend territory. So we're looking at dividends and we're looking at director loan adjustments. So there's a lot to play for here. But importantly, we're actually working with more accountants and advisors than users, because they've received letters from HMRC with a threat that they're going to be published. Their names on the naming and shaming list here because they have facilitated the avoidance. They've entered into agreements for commissions for introducing their clients, for example, and some of them already have. Some imminently are going to be published. We're working with them. It's very, very hard to get out of that. In some, there's some wiggle room, but by and large, it's a very, very difficult space. Even having made representations, I think, based on what HMRC have been provided by the promoters and what they've already seen, they seem hell-bent on publicising professionals. So, again, this potentially a conversation offline, but B2B Trade Card is the name of one of the main entities here behind this that have been running it, the cards. But you'll find HubFind, BizFind, for example, they are in the thick of this as well. Soon going to find their information published, just like B2B Trade Card. I'm conscious I want to take some questions as well, so I'm not going to run through this slide here. Safe to say that obviously the remittance basis is gone for everybody since the 6th of April this year, and we're into the FIGS regime. Whether people can use the FIGS regime depends on how long they've been tax resident here in the UK. But essentially, for the first 4 years of being tax resident in the UK, you don't pay any tax on foreign income and gains. But after that, you would. And there are lots of quirks, especially where someone's been here for a while and used to be on the remittance basis, for example. They need to know what they can and can't do going forwards. I'm I'm going to focus on the following slide because that's what I've been asked by many to cover today. Is that well, what can you do, right? What about people that were non-DOMs and obviously this new regime's coming? Let's assume, for example, they've been here for more than 4 years, so they're not going to benefit from it. They're going to pay tax on a rising basis going forward. But what else can they do? So there are only really two things that they could do, and I'm not talking about trusts today. Going to keep it quite high level and quite simple, right? But for those that were on the remittance basis, so these non-DOMs, for example, one of the things that they could do is look at their assets overseas, and if it makes sense for them, it would be a good time to crystallize a sale and get rid of them. Certainly, if they're allowed to go back and look at the 2017 value of those assets, right? If they're claimed remittance basis, and use that as the base cost today. So that may produce a small loss for someone, that might produce a small gain, but nonetheless, if they didn't rebase like this, then they'd have to use the original cost, for example, and that might produce a much larger gain. So that's one of the things that HMRC are doing. But the really interesting one that they're doing here, and we're getting lots of interest on this, but mainly we're working with wealth managers and lawyers overseas at the moment because they can see the value in this and introducing their clients. For people that use remittance basis for a long time, that could be 5 years, 10 years, 20 years, whatever it might be. A lot of these people now are sitting on pools of foreign income and foreign gains that haven't been taxed here because of the remittance basis, but they are being encouraged by the government to bring that money here, right? They could invest it here, they could gift it here, they could spend it here, or quite frankly, they might not even bring it here. They might just want to have the comfort of knowing that they've paid very little tax on it, but they might bring it in 5 years' time, 10 years' time, because you can defer it. So this process is called the Temporary Repatriation Facility. So what HMRC are saying, in a way, you can go and analyze mixed funds and analyze your offshore funds, for example, and wherever you find foreign income and gains, right, over the next 2 years, if you nominate that under the TRF facility, the tax will only be 12%, and you can bring it here to the UK and use it. Or you can pay the 12% and you can bring it in the future. But at least you secure it, pay the 12%, and then you can bring it immediately or defer it. That's one thing. And they've extended it, so there's an additional year, 3 years. The rate goes up a little bit to 15%. But again, there's an opportunity for people to bring income that would otherwise be chargeable at 40, 45%, for example, and gains which are now chargeable at 24% using these special rates. So it's definitely worth people thinking. And the way that we are seeing it play out in practice is that people don't need to worry too much about the entirety of the funds overseas because once the exercise has been done to identify foreign income, it could be stockpiled interest, dividends, for example. It could be gains on shares or properties. It's only the gain that is taxable, and the income that is taxable that will be liable for this rate of 12% or 15%, because everything else presumably is clean capital. So if you go through this exercise, people will find old money from before they became resident in the UK, and that can be brought to UK free of any tax, right? So I leave that as a nugget with people, right? So it's not everything that you have overseas is taxable at 12%. No, it's the overseas income that hasn't been taxable before, the gains that haven't been taxable before, but clean capital remains clean capital, right? So I think I've rushed through that as much as I could. That took me about 45 minutes. And like I say, the slides contain more by way of advice and examples and other topics that are of interest. But I'll allow people to read those in their own time and come back to me if and when they want to. And on that note, I'm going to say thank you very much for sparing your lunch hour today. My contact details are here as ever. And I'm going to now see if they've got any questions. I'm sorry, we've got so many people online. It's going to be very difficult to open it up to the floor. But I believe the chat is open, or the Q&A. Is it, Ishan? The chat is open, isn't it?
Q&A.
Yeah, the Q&A box is open if anyone wants to put questions in it, and then we'll take some. But of course, if the questions are too complex, they will need us to speak offline, I suppose. So let's have a look at that. Chat is off, it's Q&A, isn't it? Right, assuming it's working the way it should. As I said, the chat is off, but the Q&A box should be working. If anyone's got any questions, please put them here and we'll try and address some of them. Right, I've just changed things on my screen. I see a question here from a HM. What's your view on general partnership agreements versus LLPs for incorporation? And again, it's a valid question because from experience and obviously hearing in the market anecdotally, a lot of bespoke planning took the form of general partnerships, and it's been going on for a long time. It's not new, right? So you for example, you had a husband and wife partnership, or actually, quite frankly, people were returning joint income passively, but that was sophisticated to create a partnership and treat it as a business. And once those general partnerships ran for a few years, people then often found themselves incorporating those partnerships, and providing everything else is done to pick up the CGT relief and the stamp duty relief, for example. Those, in our view, did work. We saw some, and we've actually done the advice on these in the past. So there's far fewer of them in the market, unfortunately, though, because what people wanted were quick schemes, which brought in LLPs, and certainly the non-general partnerships planning was encouraged for use for people that didn't normally meet the criteria for general partnership style planning. So they are very different. I think my answer is because we see LLPs heavily used by less tax for landlords, and even property 118, for example. So we have to be careful, and each case has to be assessed on its own merits. I know it sounds like a bit of a cop-out, but everybody's case has to be assessed differently. Even all the people that are in the avoidance schemes, some people were running qualifying businesses and actually did more by way of steps compared to other people who just sold something. They didn't have time. They bought the scheme and suddenly they thought that they got all the tax benefits, but they didn't qualify in the first place and didn't take any active steps. So very, very different. Take some more. Will you send the slides? Yes, we've got details of everybody that's registered, so the slides will go out. We normally get a copy of the recording as well. And what I'll do, I'll download the recording, and as soon as I do that and publish it back to this website, my understanding is that everybody that registered is sent a link for that recording that they can download if they want as well. But yeah, certainly the slides will be coming out. Another question. With regards to incorporation relief for partnership to LLD, if the partner managed their portfolio from overseas, will that stop them from providing 20 hours affecting this relief? In this case, they have 30 plus properties to manage. I've never seen, Mr. W, I've never seen HMRC concern themselves with the location of the taxpayer in these inquiries, but that's largely because almost everybody I've seen was and still is in the UK, right? That doesn't mean that it affects anything, right? But you have to look at the qualifying criteria. That's all it ever comes down to. It doesn't matter what someone purported to give by way of advice or what a declaration says, right? If someone has to satisfy this business being sufficiently active to qualify for Section 162 relief, that's what someone has to demonstrate. If, for example, someone's sitting overseas but is doing all, and I don't know what type of properties they've got, but actually all the viewings are done, let's say, virtually through an online portal, right? That's quite possible. If they are managing their inventories on the way in, inventories on the way out for tenants, that's possible. They are obviously constantly looking at their financing and remortgaging overseas. They can do that if they're arranging for repairs overseas and the portfolio is big enough, for example, and you hit the threshold of, say, 20 hours plus and sufficiently being active. If by way of fact you satisfy the criteria, it should be fine, right? I've not seen anyone being denied because they're overseas, but you've got to ask yourself, when people say they're overseas and they're actively involved in the business, how would they demonstrate that? right? Especially if they use letting agents and they're suddenly doing other things and not spending the requisite amount of time, that could be quite risky. Mr. R, in the new regime for overseas income, is a UK resident for tax subject to tax on LLP income overseas, with or without remittance happening? Thanks. If I've understood this question right, I think you're saying someone's resident in the UK. They might get interest income, dividend income overseas. They might be running businesses there that are unincorporated, for example, as well. How would that be taxed without remittance? If I've understood that correctly, I would treat the LLP profits the same as a self-employed business, because the period ends, the LLP presumably is transparent, so that profit share has arisen at the end of that period, right? It doesn't need to, it no longer needs to be remitted to the UK, right? So if someone is has been there for over 15 years, they're deemed DOM already. Since 6th of April, there is no remittance basis anymore. So yes, I think an LLP profit share, if that's what the question is here, overseas LLP profit share, is it taxable here immediately? Yes, because it's arisen, it's been earned, it's been achieved. It falls same to be treated the same as self-employment income there and investment income like interest and dividends. It doesn't need to be remitted here. Got another question here asking about the property less tax for landlords scheme and the 90-day window. So I can't go into the 90-day window as much because we're just at the other side of it now. We're waiting to see more letters. But what I will say, in around mid-May, HMRC asked everybody to send in information, right? And for some people that looked like a disclosure, and other people gave basic information about the number of the properties, the values of their properties, the cost to them, for example, because everybody did something that they thought suited their needs, made them look good in front of HMRC, but not necessarily what HMRC wanted. Right? I can tell you the purpose of HMRC's questions was to raise to a assessment, because they're quite aggressive here. They'll raise the assessments. People then will say that it's not right, or they don't agree with the SDLT part or the ATED part or whatever, but they'll have to appeal, and it becomes litigious and it becomes less informal. So there's less play here. Our advice was for people to look at their own affairs in detail to see whether they qualified for reliefs and whether the planning worked for them, and if they didn't, to do a disclosure, because in the disclosure we had more flexibility of offering something to HMRC that the client could live with, as well as HMRC. However, we've actually done that for far fewer than we would have hoped, because a lot of people opted to wait to see what HMRC do after the 90 days. And now we've started seeing letters from HMRC threatening assessments. So it's haven't seen the assessments just yet, but it's getting ugly on that front. Ishan, can you see any more questions?
No, I can't.
Right. Can't see any more questions, which is the first, but I can still see a lot of people online, so I'll leave it for a moment. If I don't get another question, I'll thank everybody and bid everyone farewell, and hope to catch up offline. How do you refresh this, Ishan?
Yes, also. Can't see anything else.
Right, I think that's it. Thank you very much, everybody, for joining as usual. I hope you found it helpful, and I hope that some of the slides that we didn't cover today, which will be in the pack that you get, are of some use. And as ever, feel free to get in touch, even if you think the issue is not big enough for us, or something that could be resolved quite quickly, because there could be a steer or something that we could offer up that helps you and your client. Thank you very much. I appreciate it. Take care.